Now, we are getting more and more good news along the lines of regulation. Last year, there were some worrisome things about the IRS reporting rules. These rules essentially were going to make it to where like miners would have to report the transactions of their users, which clearly doesn't make any sense because it's not like miners can track specific users. This was also a worry for wallet operators like MetaMask. And basically now we know crypto miners are exempt from IRS reporting rules, and this is affirmed by the U.S. Treasury. The U.S. Treasury affirmed that crypto miners and wallet operators are exempt from the IRS reporting rules, preparing appropriate regulations. The cryptocurrency industry in the United States is about to score a major legal win as the United States Treasury Department plans to spare crypto miners and other ancillary parties from tax reporting rules. In a letter to a group of senators on Friday, the U.S. Treasury indicated that it plans to exempt crypto miners, stakers, and other markers. Excuse me. We have some phone calls I'm waiting on. That's not one of them, though. So in a letter to a group of senators on Friday, the U.S. Treasury indicated its plans to exempt crypto miners, stakers, and other market participants from rules that would require crypto brokers to share data on their clients' transactions with the Internal Revenue Service, the IRS. And that was going to be like basically nearly impossible for miners to do and wallet creators, right? Well, decentralized ones like MetaMask. Quote, appreciate the Treasury Department affirming that crypto miners, stakers, and those who sell hardware and software for wallets are not subject to tax reporting obligations, end quote, Senator Rob Portman said, announcing the news on Twitter. In the letter, Treasury Assistant Secretary for Legislative Affairs Jonathan Davidson said that the department's position is that, quote, ancillary parties who cannot get access to information that is useful to the IRS are not intended to be captured by the reporting requirements for brokers, end quote. Davidson also emphasized crypto validators are, quote, not likely to know whether a transaction is part of a sale, end quote, obviously, while entities involved in offering services related to hardware or software crypto wallets are, quote, not carrying out broker activities, end quote. The Treasury will also consider, quote, the extent to which other parties in digital assets market, such as centralized exchanges, and those often described as decentralized exchanges and peer-to-peer exchanges should be treated as brokers, end quote, the letter notes. Now, I think obviously for us, we don't want to see this being treated as this. So we don't want to see decentralized exchanges or peer-to-peer exchanges being treated as brokers. Centralized exchanges, that's expected. And to a certain extent, like, I think that like if you're going to cash out to, US dollar from cryptocurrency, that it makes sense that you would at that point track it and have to adhere to those rules. Whereas if it's decentralized, I don't think that you should track it or have those rules. Now, where this may change, of course, is if a stablecoin is going to be official, like we talked about here, an official stablecoin, maybe those official stablecoins don't get added onto decentralized exchanges, for example. Bloomberg reported that the Treasury is planning to issue proposed regulations to include its stance on the broker definition. As previously reported, U.S. President Joe Biden signed the $1 trillion infrastructure bill in mid-November of 2021, requiring crypto market participants to report all digital asset transactions worth more than $10,000 to the IRS. Several senators, including Pat Toomey, Ron Wyden, and Cynthia Lummis, subsequently urged the Treasury to clarify the definition of a broker in an infrastructure law in December, planning to offer related legislation. A group of House Democrats also backed a similar initiative in November. All right, so overall, a pretty big win for cryptocurrency in general. We do need to see how they're going to treat the decentralized exchanges. I've kind of pled my case there as it stands from my perspective. It was going to be basically impossible to enforce the reporting of the transactions that you validated as a miner. I think at this point, as far as like you could do the transaction in general, which you aren't already going to do because you just do your block reward. If you did that, it would probably be absolutely incredibly difficult, because especially as mining to a pool, the way it happens is like your miner doesn't always win that block. You would have to actually go through the blockchain and find all of the blocks that miner won, then report all the transactions within that block. And it really doesn't provide relevant information because there is no KYC on the blockchain. Therefore, all the IRS would get is that, okay, this transaction happened for this much, and here's where it is on the blockchain. We could give you the hash, whatever. Couldn't prove definitively who the user was or anything like that. So it's kind of a moot point. It's like wasted time for everybody, including the IRS. So I think that makes sense. Like I said, we'll just have to see where it goes for the rest of this. My hope or thought is that for the decentralized exchange part, that goes away as well. I don't think that there should be, tracking there. I understand it on the centralized exchange portion if it's converting to the currency of the country that has the regulations. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.